Welcome back to the second part of problem 1-8b, which is actually requirement number 3, which says prepare a June income statement, a June statement of owner's equity, a June 30th balance sheet, and a June statement of cash flows. Well, we've already got these completed. If you'd clicked on the tab down below and print them off, if you haven't done that, you should probably do that right now so we can complete the problem. Now remember, in the first part of the problem, we completed this little spreadsheet with the different things on it, but we also have balances down here that we can use to complete our financial statements. And we'll look at where we pull these from here in just a second. Well, the first statement that we do is always the income statement, and as I go through this, I will explain why we do these in the specific order that we do them. So we have the name of the company, which is Ken's Maintenance Company. The next line at the top is the name of the financial statement. Notice this is for the month of June. It says for month ending June 30th. If it was for the year, then of course we would say for year ending and whatever the ending month of the year was, whether it be a calendar year or a fiscal year. Calendar year would end on December 31st, whereas a fiscal year would end in the 12th month of business. Well, first off, what we need to do is we only had one type of revenue, and what was the balance of that? If we go back and look at our transactions here, our revenues were a total of $11,375. So all we need to do is put the $11,375 here in this particular column. Now, notice this is a two-column financial statement. And the reason it's two columns is because we have more than one expense. And since we have more than one expense, we are going to list all of them in this column and only put a total in this column, which makes the financial statement a little easier to read. Now, why did we start with the revenue in this right-hand column? Because the company only has one type of revenue. If they had a sales account or a different type of service account in which they were keeping track of their revenues, then underneath revenues here, they would have listed both of the titles, listed them here, and then put total revenues here in this right-hand column. So always remember, if you have more than one account that you know you're going to be adding together, list them in the left column, balance in the right column. Well, let's go back and look. These are the different expenses. I've already got them listed here for you since we're just beginning. And we know there was a rent expense, there was some salary expense, we had an advertising expense, we had utilities expense, and we had telephone expense. And that was the reason why I listed these over here on the side so that we knew which ones were which and where to list them at. Now, our first expense was the rent expense, and if we go back and look, the only rent expense for the month was this $4,500. So we'll go put that here next to rent expense of the $4,500. Now notice I didn't put this in as a negative on the income statement because I know these are expenses. I'm going to add them all up, and I know that expenses are subtracted from revenues to arrive at either a net income, which means our revenues are more than our expenses, or it could be a net loss, which means that our expenses are more than our revenues. Salaries expense. Now, you can go back and look at the statement, but I also know that we made two payments to our employee of $900 each, so the total of that is $1,800. I also know that we only had one entry for advertising expense, and so I know it is $1,125. I know the utilities expense was $525, and the telephone expense was $120. And of course, I could add these up right here if I wanted to, but in reality, if I go back and look at my spreadsheet that I used, my expenses, they should all total up to $8,070. So I already have the total. Now, to figure out again, in this case, the net income, and I know that because my expenses are less than my revenues, I would subtract my expenses from my revenues to arrive at that net income. So now we have completed the income statement. We have a net income of $3,305. Now the reason we complete the income statement first is because we know that revenues increase equity, expenses decrease equity, but the combination or the net income, net effect, either is an increase or decrease to equity. It's net income, that would be an increase. If it was a net loss, we would decrease it. But since we have the income statement completed, we want to go straight to the statement of owner's equity, take this net income of $3,305 and put it right here next to net income. Now, because this company began at the beginning of June, we will actually say that the capital account on the very first day before we made any investments, or the owner made any investments, was actually zero. And then the investment by the owner is that $120,000 in cash that Keystone actually invested into the business. So with that, there's no title here, but what we're going to do is we're going to add these three columns up, which is a total of $123,305. Now, we had some withdrawals, and the amount of withdrawals, which is on the worksheet also, was $2,000. And so to find Keystone's capital balance on June 30th, we would take and subtract the actual withdrawal from this total here, which means that our capital account has a balance of $121,305. Now this was the statement of owner's equity. Notice, name of the company, name of the statement for the month ending June 30th, because both the income statement and the statement of owner's equity statement are actually historical documents. They're showing you the effects of past transactions. However, when you look at the balance sheet, you'll notice that it has the name of the company, the name of the statement, but it says June 30th, not for the month ended, but June 30th. The reason for this is that a balance sheet actually is a snapshot of what all of the account balances were on that one particular day. If this is an ongoing business, we know that there are going to be some transactions probably the very next day, which would change these accounts and their balances. So one of the other things is we completed the statement of owner's equity. We need to make sure that we take this balance right here that we arrived at and come down here and put it in the owner's equity section on the balance sheet. And so we'll put that $121,305 next to Keystone Capital. Now another thing about the balance sheet, if you look at it, what do you see? Assets, liabilities, owner's equity. So this is really the accounting equation. We know then that our total assets have to equal our total liabilities and owner's equity. So in this case, we can go back to our actual spreadsheet. What was the balance in our cash account? Well, if I go here and look, my balance is $118,080. So I'll put that in my cash. And again, looking at the spreadsheet, I also saw that the accounts receivable had a balance at the end of the period of $125. And I know that equipment has a balance of $2,400. And that is all of the assets I have. So what I want to do is I want to add up all of my assets, which gives me a balance of $121,305. Now, if you go back to the transaction page, did we have any liabilities? Otherwise, our accounts payable account? No, we had actually paid that off, so the balance is zero. If I come back and look at my statement, then my accounts payable, I know, has a zero balance, which means if I add this to this, it comes up to a total of $121,305. So we've gone this far, we've got our balance sheet completed, and our assets do equal our liabilities plus owner's equity. But because we actually did this on the other page, we knew that this should probably happen and that our accounting equation was in balance when we had finished all of our items and transactions. So now what about the statement of cash flows? The one thing that you always have to remember about the statement of cash flows is that the only thing that appears on the statement of cash flows is if, of course, it involves either an inflow or an outflow of cash. Now, there are three different sections of the statement of cash flows. We have the operating activities section, which means cash flows for our normal everyday operations of our business. We have an investing activities section, which means an investment in either, investments such as stocks or bonds, but also if we are investing in any non-current assets, and that would be like equipment. And so we're going to show the inflows and the outflows of cash for investing activities. And then the final section of the statement of cash flows is the cash flows from financing activities. And financing activities can either be equity financing or it can be debt financing. If it is equity financing, that means that the owners are either investing some type of asset such as cash or equipment to the business. And in this case, since it is the statement of cash flows, it would only involve cash invested by the owners or a withdrawal of that cash from the business. If it is debt financing, that means that you would either receive cash by borrowing from a creditor, or you would be paying the principal off to that creditor. Any interest paid on debt is actually shown in the operating activity section of the statement of cash flows. So let's go through the process of looking at what our totals of inflows and outflows were for the operating activities of the statement of cash flows. Now, when we finish the statement of cash flows, let me go back to that real quick. If we look up here on our balance sheet, we see that the balance in cash is $118,080. What the statement of cash flows does is it shows how the company arrived at that balance in their balance sheet. So what is the amount of cash that we received from our customers? Was it the total amount of our revenues? And the answer, of course, is no, because $825 of that revenue is still in accounts receivable, and our customers haven't paid us yet. So if we take the amount of revenues we have here, and we subtract out the amount that our customers still owe us, that should give us the amount of cash that we actually received during this period from our customers. And that would be $10,550. Now this, of course, is a positive amount. What about the amount of cash we paid for rent? If we go back and look, we see that we paid our rent, which is an outflow of cash, which would be a negative amount, so it's a negative $4,500. We also paid cash for advertising, and if we look at each of these, paying for rent, paying advertising, paying for our phone in our company, paying for the utilities, paying our employees, those are all expenses and cash outflows here that are actually part of our everyday operations of our business. Well, what was the amount of cash that we paid for advertising? Well, that was $1,125. The cash that we paid for the telephone was $120. The amount of cash we paid for utilities was $525. And the cash, of course, that we paid our employees during the period was $1,800. And so what we do, notice this says, and I've already got the titles in here, but it says net cash provided by operating activities. If I say provided by, that means that this number over here is going to be a positive number. And again, notice two-column statement. We're going to have several accounts that when we find the net amount of those added together, we're just going to put the total over here in this column. We find that we have a net cash that was provided by the operating activities of $2,480. Well, what about the cash flows from investing activities? Well, the only investing activity that happened during the period was purchasing equipment, and we did pay for it. Even though we bought it on account earlier, we eventually paid cash for it. So we would record the $2,400 outflow. And in this case, notice what this says. It says used by. So you want to make sure that you use the proper titles. If this balance over here is going to be positive, it's provided by. If it's going to be negative, which this is a negative $2,400, because we had no other investing activities, it is used by investing activities. And again, we put it over here in this column. Now what about the financing activities? Well, the owner invested in the company $120,000 in cash. Now remember, if they had invested $60,000 in cash and say $60,000 in equipment, the only thing that would show up on this statement are those items that actually involve either an inflow or an outflow of cash by the business. Now, the owner also withdrew $2,000 in cash, which would be an outflow, so a negative amount by the withdrawal by the owner. Now, this does say provided by. Obviously, we already know it's going to be a positive number because $120,000 is obviously more than a negative $2,000, which leaves us with a net of $118,000. Now, I already have the titles in here, but if you were having to fill these in, notice it says net increase in cash, and the reason I already have that there is we know that this positive is definitely much larger than this negative. So we want to sum those up, and we arrive at a net increase of cash of $118,080. Now again, because the business began on June 1, we say that the business had a balance of 0 in the cash account at the beginning of the month. So when we add the increase to the 0 balance, we end up with a cash balance on June 30th, otherwise the end of the month, of $118,080. And when we look at this, we go back up here, we completed the balance sheet, we see that the cash balance is $118,080. And that should equal what our balance is on the statement of cash flows when we are finished. Again, the statement of cash flows just lets investors or creditors know where that $118,080 comes from. And with that, that is the end of problem 1-8B.